Hello, and welcome to the second part of Chapter 5, and this will involve taxes. All right, we're going to be discussing pages 5.7 through 5.11, and on Schedule A, we'll be looking at lines 5 through 9. Okay, generally, what you are going to put on line 5 is the amount of state and local income taxes that were paid on your paycheck. All right. In Indiana, we have both a state income tax and a county income tax. Specifically, in St. Joseph County, Indiana, okay, we have a state tax which is 3.23%. and a county tax which is 1.75% for a total of 4.98%, and that should have been roughly what was assessed on your W-2 depending upon how many allowances you took. All right, so you would look at the state tax withheld and the county tax withheld amounts on your W-2s, and you would record those on line 5 of Schedule 8. All right, that's what most people will do in the state of Indiana. All right, now there are a lot of states that don't have a state income tax. All right, for example, Florida doesn't have one, Texas doesn't have one, Nevada doesn't have one. Okay, so people in those states would look at line 5B of Schedule A and deduct their sales tax. Okay, now generally you can deduct the sales tax you pay on a motor vehicle, all right, plus any other sales tax that you paid throughout the year. Okay, now that can get a little cumbersome. Okay, most people don't keep receipts every time they go to the store. All right, so for those people that live in states without an income tax, all right, and want to take a general sales tax deduction, they will use the tables on page 5-8 in your book and compute their sales tax deduction, all right, using page 5-9. But for most people in the state of Indiana, all right, okay, that itemize and have a job, they're going to deduct their state and local income taxes that were withheld from their paycheck. All right, on line 5A, you would also put any state taxes that were paid to other states. All right, so for example, if you lived in Indiana and you worked in Michigan and they withheld Michigan income tax, you would put that on line 5A. Also, if you owed taxes to any state in the prior year, which would have been 2016, all right, you would put that amount on line 5A of your return. Okay, all right, also if you paid any estimated state income taxes, all right, you would record that on line 5A of Schedule A and record them as payments, not deductions, but as payments on that state's income tax return. All right, so generally also what I do whenever I do a return, just to make sure that I'm accurate, all right, I will use the tax software to put all the numbers onto the W-2s. The numbers on the W-2s automatically flow through to Schedule A. And then after I get all done, I will add up all the amounts on the calculator and compare them to what I see on line 5A to make sure that I entered them correctly. All right. Line 6, all right, line 6 are the real estate taxes that you pay. Now remember, these amounts have to be paid, not just assessed. Okay, you can't take a deduction for a tax you did not pay. All right, so now we're up to page 510, all right, and they talk about property taxes. All right, now remember that this is a federal return. So you can deduct real estate taxes, property taxes, that you paid on any property anywhere in the United States. All right, that would also include vacation homes you have somewhere else, all right, and or if you are subject to taxes on a timeshare or anything like that. All right, but you have to watch out though on the Indiana return. All right, on Schedule 2 of the Indiana return, you are allowed a deduction for real estate taxes, but only for the taxes paid on your primary residence. Okay, all right, so you've got to watch that. All right, you got to watch that. You can't put, taxes you paid to Florida, as real estate taxes paid to Indiana on your Indiana return. All right, okay, so that's line 6 of Schedule A. All right, the other thing that you also have to make sure is if somebody comes in and gives you a 1098 INT, that's 1098-INT, short for interest, and it shows an amount paid for real estate taxes. Okay, in your conversations with your client, ask them, hey, did you buy a house this year? Especially if you've done this client before and you notice that the address changed from one year to the next. All right, or they brought in last year's tax return, and you've got them as a new client and notice that the address changed. Ask them if they moved. All right, because it's very important. If you look at page 510, there's an example at the bottom of the page where it says William purchased a new residence from John in 2017. In real estate, taxes are paid in arrears. All right, so in other words, when you make your payments in May and November, you are paying the taxes that were assessed in the prior year. Okay, so anytime somebody gives you a 1098 for 2017, okay, that means those are the taxes that were, assessed in 2016, and that would have been paid in May and November of 2017. So what does that deal with this? Well, if your client bought a home in the middle of the year, then the taxes are prorated between the buyer and the seller. Okay, because the buyer ends up paying the full amount of the taxes the following year, okay, the buyer gets a credit against their real estate taxes on line 5 on line 6 of Schedule A. So it is possible that line 6 of Schedule A could be a negative number because it's actually income. All right, the seller is paying the real estate taxes for the year of sale, all right, and the buyer gets a credit for those taxes, and then because of course the buyer ends up paying the full year taxes on the following year. Okay, so again, just something to watch out for. All right, line 7 and line 8, all right, you have personal property taxes and other taxes. Okay, in the state of Indiana, we are subject to an excise tax. Now, it will tell you in your book, if you go to page 5-7, all right, it says that excise taxes are not deductible. In Indiana, we charge an excise tax. It's on your registration, but that one is deductible because it is based on the value of the car. Okay, it's what we call an ad valorem tax. That's AD space VALOREM. It's Latin for of value. It's an ad valorem tax, and that is deductible. All right, so when you get a client who, ask them, how many vehicles do you have? And they're like, oh, we got a couple cars. I ask them, let me see your registrations. All right, and what you're doing is you're looking at the registration and you're looking for the excise tax, and then you have to subtract any excise tax cut, like a 50% cut. All right, and then you would put the net difference on either line 7 or line 8 of Schedule A. All right, none of the other fees on the registration are deductible. In other words, the plate fee or any other flat fee, or personalized plate fee, the wheel tax, none of those others are deductible because they are flat amounts and are like they're fees. They're not taxes. All right. Now, even though you have a wheel tax, the wheel tax is a flat fee, but it's not based on the value of the vehicle. Therefore, it is not deductible. So only the excise tax minus any excise tax cut is deductible if it is an Indiana-based vehicle. Okay? All right. That's it for this section of Schedule A.